I'm staring at a car loan statement that's making my stomach drop. The total interest paid over 5 years is $13,491. That's on top of the $28,900 purchase price, and it's not even the worst part. You're probably sitting there thinking, that's just how it is when you buy a car, right? But what if I told you that most people have no idea what their monthly car payment actually costs them over the life of the loan? I mean, think about it. When you're at the dealership, they're throwing numbers at you, and you're just trying to get out of there with your new set of wheels. You might not even realize that your monthly payment is only covering a fraction of the total cost. Let's say you're making $51,340 a year, and you just bought a car for $28,900. Your monthly payment is $549, which seems manageable, right? But over the course of 5 years, that $549 monthly payment is going to add up to $32,891. And like I said, $13,491 of that is just interest. So, you're essentially paying $13,491 for the privilege of driving a car that's already lost value the moment you drove it off the lot. Now, I know what you're thinking. What's the alternative? Well, that's what we're going to explore in this video. We'll dive into the actual costs of a monthly car payment, and I'll show you how to calculate the total interest paid over the life of the loan. By the end of this video, you'll be able to make a more informed decision about whether that new car is really worth it. For example, let's say you're considering a $35,000 car loan with a 6% interest rate over 6 years. Your monthly payment would be around $566. But have you ever stopped to think about how much of that payment is actually going towards the principal? It's probably less than you think. In fact, in the first year of the loan, only about $2,400 of your payments will go towards the principal. The rest, around $4,300, will be interest. So, what can you do to avoid getting stuck in this cycle of debt? First, you need to understand the true cost of your monthly car payment. That means calculating the total interest paid over the life of the loan, and factoring that into your decision. You should also consider saving up for a larger down payment, which can help reduce the amount you need to finance. And finally, you should think about exploring alternative options, like buying a used car or negotiating a better interest rate. I want to share a story with you. My friend, Alex, was in a similar situation. She had just graduated from college and was making $43,800 a year. She wanted a new car, so she went to the dealership and financed a $25,000 vehicle. Her monthly payment was $421, which seemed reasonable at the time. But over the course of 5 years, she ended up paying $11,319 in interest alone. That's almost half of the original purchase price. Now, I know that's a pretty shocking number. But the good news is that Alex was able to pay off her loan in just 4 years by making extra payments and refinancing to a lower interest rate. And that's what we'll talk about next: strategies for paying off your car loan faster and saving thousands of dollars in interest. One strategy is to make bi-weekly payments instead of monthly payments. This can help you pay off the principal balance faster and reduce the amount of interest you owe. Another strategy is to use the snowball method, where you pay off your car loan with the smallest balance first, while making minimum payments on your other debts. And finally, you can consider refinancing your car loan to a lower interest rate, which can save you thousands of dollars over the life of the loan. So, let's recap. We've talked about the true cost of a monthly car payment, and how to calculate the total interest paid over the life of the loan. We've also discussed strategies for paying off your car loan faster and saving thousands of dollars in interest. And finally, we've explored alternative options, like buying a used car or negotiating a better interest rate. If you're struggling to pay off your car loan, or if you're just trying to make a more informed decision about buying a new car, I want to hear from you. Drop your biggest debt in the comments below, and I'll do my best to provide some guidance and support. And if you found this video helpful, be sure to hit the like button and subscribe to our channel for more personal finance tips and strategies. In our next video, we'll be discussing the pros and cons of leasing a car versus buying one outright. It's a topic that can be confusing, especially with all the different options and terminology out there. But don't worry, we'll break it down in a way that's easy to understand, and provide you with the information you need to make a smart decision. Thanks for watching, and we'll see you in the next video. Let's take a closer look at the numbers. For instance, if you're financing a $30,000 car with a 7% interest rate over 5 years, your monthly payment would be around $583. But over the course of the loan, you'll end up paying a total of $40,771, with $10,771 of that being interest. That's a staggering 35% of the original purchase price. And if you were to extend the loan to 7 years, the total interest paid would jump to $14,331, which is nearly half of the original purchase price. To put this into perspective, let's consider the opportunity cost of paying all that interest. If you were to invest $10,000 in a high-yield savings account earning 2% interest, you'd earn around $200 in interest per year. But if you were to pay $10,000 in interest on a car loan, you'd be losing out on that potential earnings. And over the course of 5 years, that could add up to a significant amount of money. Another factor to consider is the impact of inflation on your car loan. Let's say you're financing a $28,000 car with a 6% interest rate over 5 years. If inflation rises by 2% per year, the purchasing power of your money will decrease, making the loan even more expensive. In fact, if inflation averages 2% per year over the course of the loan, the total interest paid would increase by around $1,300. It's also worth noting that car loans can have a significant impact on your credit score. Missing just one payment can lower your credit score by as much as 100 points, and a lower credit score can make it more difficult to get approved for future loans or credit cards. In fact, according to a recent study, 1 in 5 car buyers have experienced a drop in their credit score after taking out a car loan. Now, let's talk about the benefits of paying off your car loan early. If you're able to pay off your loan in 3 years instead of 5, you could save around $2,500 in interest payments. And if you're able to pay off your loan in 2 years, you could save around $4,500 in interest payments. That's a significant amount of money that could be used for other expenses, such as saving for a down payment on a house or paying off high-interest debt. To illustrate this point, let's consider an example. Suppose you're financing a $25,000 car with a 5% interest rate over 5 years. Your monthly payment would be around $472. But if you were to pay an extra $100 per month, you could pay off the loan in just 3 years and save around $1,800 in interest payments. And if you were to pay an extra $200 per month, you could pay off the loan in just 2 years and save around $3,300 in interest payments. In addition to paying off your car loan early, there are other strategies you can use to save money on your car loan. For instance, you could consider refinancing your loan to a lower interest rate. If you're able to refinance your loan from a 7% interest rate to a 5% interest rate, you could save around $1,500 in interest payments over the course of the loan. And if you're able to refinance your loan to a 4% interest rate, you could save around $2,500 in interest payments. It's also worth noting that some car loans come with prepayment penalties, which can make it more difficult to pay off your loan early. However, many lenders are now offering loans with no prepayment penalties, which can give you more flexibility to pay off your loan on your own terms. In fact, according to a recent survey, 75% of car buyers prefer loans with no prepayment penalties, and 60% of lenders now offer loans with no prepayment penalties. Finally, let's talk about the importance of reading the fine print on your car loan contract. Many car loans come with hidden fees and charges that can add up quickly. For instance, some lenders may charge a loan origination fee, which can range from $100 to $500. And some lenders may charge a prepayment penalty, which can range from $200 to $1,000. By reading the fine print on your car loan contract, you can avoid these hidden fees and charges and make a more informed decision about your car loan.